Hey guys, my name is Rod Moser with NextHome Navigator here in Salt Lake City. We had some pretty big news hit the market yesterday as one of the local tech startups, a company called Homey, came out of the news and said that they were going to be laying off a third of their staff due to the changing real estate market. Now, that's some pretty big news here locally, but it's also interesting for a lot of different reasons. Number one, there have been several economists come out and say that the Salt Lake County real estate market is supposed to be the hottest real estate market in the entire country, that we're expected to see, again, double-digit appreciation this year. With a lack of inventory and a booming demand and a really healthy economy, we're expected to see the housing market remain strong through all of 2022. So why would a company locally say that due to the changing market, they're going to lay off a third of their staff? The other interesting thing is the timing. It's February. Typically in Salt Lake County and in the Wasatch Front, we see an explosion of new listings hit the market at about this time of year. It's the spring selling season. It's one of the hottest times of our market. And to have a company with a large market share decide to lay off a third of their staff, again, is kind of interesting. Now, if you've watched a couple of my videos in the past, you know that I've talked about Zillow and their iBuyer program and how it wasn't working and they were losing tens of thousands of dollars on every one of their sales. If you're not familiar with that, you can watch that video. I'll put the link up here as well. But that's some they've recently laid off a huge portion of their staff as well because they were hemorrhaging money on that side of their business. I've also talked about a company called Redfin and how investors had kept a company afloat that had never been able to show that it could turn a profit. A company that's traded publicly, so investors are out there pouring money into this company and they've never actually produced a profit. This one is interesting, and let me just share the article with you. That you could Google this. You could probably find this information a lot of different places. I happen to use TechCrunch, which is the first place I pulled it up with Google. But citing changes in the real estate market, Utah-based Homey lays off 1/3 of its staff. This is what the article says. Homey was one of the many prop techs that started out as an online brokerage aimed at helping home buyers and sellers navigate the purchase and selling process. It became known for cutting out traditional closing costs, 6% real estate commissions, and the arduous paperwork associated with traditional home sales. Over time, in an effort to be a one-stop shop, Homey expanded into providing home loans, insurance, and title services. So it was a company that was doing really well. Another piece about this, according to Crunchbase, Homey has raised a total of $35.1 million in venture capital since its inception. Okay, so another company that's being propped up and had a good idea. A lot of investors were putting a lot of money into this company to the tune of about $35 million. And now to see them laying off large portions of their staff, maybe some strategy changes in the near future. Okay, so I wanted to understand a little bit about why this is happening. What exactly is going on? I wanted to compare the Wasatch Front Multiple Listing Service, everybody that reports to the Wasatch Front Regional Multiple Listing Service, and then take a snapshot of Homey as well to see what exactly the data is telling us and why would it require them to lay off so many people. So here's the information. Hopefully you can see this okay, but we're just going to look at this conceptually right now. So this is the entire Wasatch Front Regional Multiple Listing Service. And what I did is I compared the counties of Salt Lake County, Davis, Utah, Tooele, and Weber County. These are the largest population counties along the Wasatch Front. So that's the data that I pulled. And the black line, which is what we're focusing on, are the total number of homes sold. So it will show first quarter of 2018, 2019, 2020, and 2021. So the last 4 years. Now you'll notice that the second and third quarters are typically the highest selling quarters in our market. So those are the hottest markets. So here's the data for the Wasatch Front. And here's the same data for the same counties for Homey. Now, the first thing that I noticed is the volatility in this graph versus this graph. You've got a little bit more flat graph and you've got a little bit more volatility. You're also seeing a pretty significant drop off from the peak of the third quarter of 2020 here and for Homey, and you don't see that same drop off for the board. Now, these numbers were a little bit hard to see, so I transferred this data to an Excel spreadsheet. So these are the same numbers, and I've put in some percentages. So what I wanted to see was Homey's percentage of market share. Now it's got the listed and the sold numbers in here. It's got all of the data, but I wanted to take a look at the total market share percentage. And then we're going to look at year-over-year reports for the entire Wasatch Front Regional versus the year-over-year reports for Homey. So the first thing that I want to share with you, these guys they have a brilliant marketing strategy. In fact, it's one of the best marketing strategies I've ever seen. They have spent a ton of money on billboards. They sponsor the 2 professional sports teams in Utah. So if you watch a Jazz game, you see their brand and their logo everywhere. If you watch a Real Salt Lake game, you see their brand and their logo everywhere. These guys have spent a lot of money to capture market share. And I want to, and as we look at these numbers, I want you to understand a 2% market share for one company is a really large portion of the overall sales. That's a really big market share. So let's go ahead and take a look at the spreadsheet really quick. Back in 2018, Homey had about a 2.2% market share. Now these guys are spending a lot of money. They're starting to get well known. You're starting to see a lot of their signs out there as listings because they advertised that they were saving people thousands and sometimes tens of thousands of dollars in commissions based on maybe hiring a traditional agent. So their market share percentage started to climb, and you'll notice that it got as high as 5.5% of all of the sales in the third quarter of 2020 were being done by this company. Then we start to see the drop. Now, this is interesting because the market has gotten hotter and we're seeing a drop off in just over a year. So about a year and 3 months, in 15 months time, they've lost about 2% market share. That's pretty significant. So let's come down and look at year-over-year reports. Now, this is kind of boring, but you'll kind of see that year-over-year, starting in the second quarter of 2019, we had 106% of the sales that we had in 2018. So a 6% increase, a 10% increase for the board, a 7% increase. It got up as high as a 16% increase year over year from 2019 to 2020. Now, there's a lot of information out there about what's going to happen. Are we heading into a crash? What I can tell you is that property values in Salt Lake County, the median price range skyrocketed. The average size of a home is about 2,200 square feet in our community based on all the numbers. And we went up over $50 per square foot. I mean, the price increase of median homes over the last year has gone up about $110,000 to $120,000 for the average size home, over $50 a square foot. So we've seen that spike. Because our income hasn't increased at the same level as the housing prices, we're reaching that point where affordability is becoming an issue. A lot of the people can no longer afford to buy these homes, and so you'll start to see a natural leveling off and potentially a slight correction in the market just based on affordability. So that's kind of what we're seeing right here as we look at, over the third quarter and the fourth quarter of 2021, we actually started to see that we had sold fewer homes year over year, about 16% in the third quarter and about 10% in the fourth quarter, but we're starting to sell fewer homes year over year. Let's go ahead and take a look at Homey's numbers. Now, this is amazing to me. The growth that happened in this company as they took market share from 18 to 19 year over year, they were almost 200% in the fourth quarter in 2019 versus 2018. Now, those numbers really remained high. They were still seeing increases year over year. My guess is that they had to hire a lot of staff because of the increase year over year in their personal productivity. What's interesting is now we're seeing a dramatic decrease, and it's actually decreasing at a much faster rate than the overall market. So they were 93% year over year in the first quarter last year, 72% year over year in the second quarter. And then look at the third and fourth quarters. They're at 59% of what they did the prior quarter year over year. So they're seeing a 40% difference year over year in their total number of sales. Now that's a pretty dramatic decrease, which is probably why they've made the decision to really cut back their staff, even though the timing doesn't seem very logical. Now, I've done some other videos in the past specifically about this company where we talked about the brilliant marketing campaign, and maybe, just maybe, the business model is starting to get exposed. The marketing campaign was 100% accurate. They talked about saving people thousands of dollars in commission. The other side of the story, as I dug into the numbers in the past, is that on a price per square foot, they were selling an average home significantly lower on a price per square foot basis than a traditional agent. So let me ask you this. If you save $15,000 in commissions on the sale of your home, but you sell your home for $20,000 or $25,000 less than you could have, how much money did you really save? Now, let me say that again. If you save $15,000 in commissions, but you sell your home for $20,000 or $25,000 less than you could have, how much did you really save? Well, actually, it's a net loss of about $10,000 to $15,000, right? That's what the numbers were bearing out. Maybe that's being exposed. A lot of companies have to make adjustments as they mature and as markets and different things shift and change. I think it's interesting that they're starting to lose market share very rapidly in a market that's still very healthy and very strong. Guys, I would love to hear your feedback on this, right? We don't want to bash anybody. I'm not picking on anybody. I'm not celebrating the fact that there's a company that's struggling a little bit right now. In fact, it's really interesting, and we pay attention to our competition for a lot of different reasons, right? What do we need to adjust? How do we need to change the way that we're approaching the business? And to be quite honest with you, this was a really healthy model for a lot of people. You know, it actually made real estate agents be accountable to the amount of money that they're charging the consumers. Can we create a net positive for the people that we're working with? And so I think this is really healthy. Competition is healthy. I think this is a good thing. And I also think that this might be that the company is being exposed a little bit. Guys, I appreciate you paying attention. Please comment. I would love to hear your opinion. Again, this is just my opinion. I would love to hear your opinion about what you think about the layoffs, about the timing, and kind of what you think about the real estate market moving forward. We appreciate you watching, you guys. I look forward to seeing your feedback.